Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Well, I want to go back to when you were 25 years old. You wrote it was a joke, but it wasn't. It was a serious idea about time and space and interstellar planets and all that. The final sentence of Krugman at age 25. Those of us working in this field, I'm going to paraphrase, of international economics and trade are still a small band, but we know that the force is with us. Dr. Krugman, where is the force this morning?
This is Professor blowing off steam with a paper about interstellar trade. So what the hell?
Where is the force this morning for this nation?
Oh boy, this is really, really bad. I mean, you want to say this is we're talking about assuming the Rose Garden, anything like what Trump announced in the Rose Garden is actually going to be where we land. We're talking about tariffs that are significantly higher than Smoot-Hawley. And of course, starting from very low. So this huge jump in tariff rates with a U.S. economy that's 3 times as open to international trade as it was in 1930. So this makes Smoot-Hawley look like a rounding error. And it's so that's really bad. And it's also it's highly uncertain. Never had a situation where really you have no idea, but within like 20 points where the average tariff rate is going to be a few months from now. So this creates an impossible environment for business. It's hard to imagine a worse trade policy than what we're getting.
In the cacophony, Paul Krugman, we have nations acting. Last night at 9:15, I picked up my phone and there was China acting. China just says no. Trump lives on negotiation. Folks, Bloomberg's Tim O'Brien owns the high ground on this. He lives on negotiation. John Bolton, writing in the Telegraph, says he lives on negotiation. If the Chinese don't negotiate, what happens to Paul Krugman's trade economy?
Oh, I mean, starting point here again is that negotiate about what? Now, China, you could conceivably have some. China is not a free trade economy, and they might be able to make some concessions, but they ain't gonna. Their back is up, and they have national pride, and their economy, by some measures, is as big as ours, or bigger. So you don't want to. They're not for moving, and the other players. I mean, think about the Europeans. Europe had an average tariff of about 1.7% on U.S. goods. Has still about 1.7% on U.S. goods. What can they give? What concessions can they make? It's not as if Trump is asking them to do something. Is asking them to remedy some real sin. He's sort of made up a story about how they must be doing something wrong, but they aren't actually. And so they even if he wants concessions, they can't give them.
Professor, I think if we just step back a little bit, I think the basis of the Trump administration tariff policy is that they're trying to reorder the world economic order. Is there something fundamentally broken about the world economic order that disadvantages the U.S.? Actually, no. I mean, when all is said and done, the U.S. runs an overall trade deficit, but that's mostly because the balance of payments always balances. If you attract inflows of foreign capital, then the math says that you have to have a trade deficit. That's I know mathematics has a progressive bias, but still, that's what the math says. And the U.S. is an attractive place to invest, or was until now. So the idea that there's something fundamentally wrong just doesn't make sense. And it's worse. I mean, Trump and his people think not only that the U.S. shouldn't run a trade deficit, but that we shouldn't run a trade deficit with any country, that everything should be bilateral balanced trade, which is just crazy. I mean, if you think about people, if you work for somebody else, well,
you run a surplus with that person because they pay you and you probably don't spend much of your income on their products.
Right.
On the other hand, you run a bilateral deficit with your supermarket because you buy from them and they don't buy stuff from you. And so, the same applies to countries. So it's just crazy. And I don't know. I think all of this stuff about remaking the international order is window dressing. It's the fundamental thing is Trump wants tariffs. And then everything else is people trying to explain why, retconning explanations of why he wants tariffs.
Yeah, Jason Furman in the FT this morning really writing up this complete focus on getting tariffs in to go back to the 50s, the 30s, or maybe 1905. We welcome Paul Krugman, of course, iconic at Princeton University. You know him from the New York Times. He just went out the door. He has a Substack. It's a value. I got 2 Substacks for you. I got to mention Paul Adam Tooze, who's killing it out on Substack. But Adam Tooze, subscribe. Paul Krugman, subscribe on Substack as well. We welcome all of you across the nation on YouTube worldwide with the laureate, Paul Krugman. Paul?
Professor, is globalization from an economic perspective, is that dying as we see it?
Well, the truth is we don't know, which is part of the problem. It's this enormous uncertainty. But yeah, we have built up this very integrated world economy with all of these, supply chains and so on, which cannot survive a 23% average U.S. tariff rate. So this is going to really snarl things up.
I think, Paul, that people are understanding the jump condition in tariffs. I'm going to go back to Trump 1. You did a wonkish. Paul, you should read the wonkish Krugman in the Times. You'll age. Paul, you did like a wonkish trade. You got a chart. On the y-axis is price of imports. On the x-axis is the volume of imports. Now with Trump 2, that chart is just shattered. There's no other way to put it. You have a welfare loss. If we explode the price of imports, if we have the volume of imports decrease a lot, slower real GDP, slower nominal, slower investment, how big can that welfare loss be? And who listening right now loses?
Okay. The thing to always to realize is that roughly speaking, we think that the damage done by tariffs is not proportional to the tariff, it's proportional to the square of the tariff. So, a 20% tariff is something like 4 times as bad as a 10% tariff. Now, putting numbers to it, long run, it's funny thing. The long run impact of these tariffs is probably, it's going to be worse than Brexit. So in Brexit, we tend to think it was 3 or 4% of British GDP, maybe. This could easily be more than that, though there's a limit to it. It's hard to get. It's not, in itself, it's a serious hit to the economy. But the funny thing is, in the short run, it can be worse. And the reason it can be worse is the extreme uncertainty that we're creating. And so, once we, even with these high tariffs, we'll settle down eventually. Business will find ways to cope. Costs will be higher. GDP will be lower. But that's, we'll make that transition. But right now, if you, I can only imagine that a lot of manufacturing managers are, if they aren't drinking, the more power to them because they should be. Any move you make may turn out to be disastrous because God knows what the tariffs will be by the time the investment matures.
What you just heard there from Paul Krugman, folks, is absolutely critical. I want to translate it a little bit. He mentioned some math, the square of the tariff. This goes back to literally Newtonian physics. Think 1, 2, 3, 4, 5. No, maybe exponential. 2, 4, 8, 16, 32. That's an exaggeration, but you get the idea. Paul, let's bring it right over to America. Are we going to have a square of the unemployment rate? Are we going to see different labor metrics, including the 4.x unemployment rate, explode higher?
Okay, I think we will, but that's not in the long run. That's the thing. Tariffs, what is the impact of tariffs on the unemployment rate under normal conditions? And the answer is not much. It makes labor less efficient, but it doesn't cause a slump. It just means that people do different things. They do worse things, but they stay employed. So that it's not really the unemployment rate. It's productivity that will suffer. It's real incomes that will suffer in the long run. But we may very well now, I think better than even odds, that we are going to have a recession this year, which is not the standard effect of tariffs. Normally, if you ask me, do tariffs cause recessions? I would say no. The whole story about Smoot-Hawley caused the Great Depression, that's basically a wrong story. Smoot-Hawley was a bad thing, but not for that reason. But the uncertainty, which means that if you invest, should you invest more in your Mexican components plant? Well, not if we're going to have 25% tariffs on Mexico. Should you invest in U.S. production instead? Not if those tariffs might not stay in place and you really wish that you had invested in Mexico. Right. So there's going to be a lot of just playing cash sitting on the sidelines while businesses wait for some clarity, which it doesn't seem to be coming anytime soon.
Professor, it was just as recently as the beginning of the year that Tom and I were having discussions with our guests here in Bloomberg Surveillance about U.S. economic exceptionalism. Boy, that seems quaint now. Is that still the case here? How do you think about that vis-a-vis U.S. and the rest of the world?
Well, if you wanted to kill U.S. exceptionalism, this is kind of what you would do, right? There's much more. It's not just the tariffs, but yeah, the U.S. from about 2000 on, the U.S. had much faster productivity growth than other advanced countries. We just outperformed, and we also have somewhat better demography than other advanced countries. So we just had a much better growth picture than anyone else in the advanced world. All of a sudden, we're disrupting our trade, although we're disrupting other people's as well. That's a bad thing. Should we bear in mind that in the background, this isn't the only radical departure in policy that the Trump administration is pursuing. Look at what is happening to scientific research. Enormous cuts in mass layoffs. I mean, the CDC is laying off medical scientists so fast that they're actually that samples are being left in freezers with nobody to look after them. And since ultimately U.S. technological progress relies a lot on the spillovers from government research, we're actually crippling, make America not great again. I mean, this is really amazing.
Paul Krugman with us. He continues with us, the laureate. Of course, I can't say enough. This moment you're in America, the questions you have in the living room, the kitchen table. This is what Krugman was weaned on years ago at Yale and on to Princeton as well. Look to his Substack out. I can't say enough about it. I really subscribe to that as a huge value add. Paul Krugman, I've got to go over, and I guess this goes Mundell and on to Jacob Frenkel and Ken Rogoff and the rest, to the currency. You studied under the guy who invented modern foreign exchange, Rudiger Dornbusch. We lost him tragically years ago of cancer. What would Rudy Dornbusch say right now, or Paul Krugman say, about the idea that China's solution is to depreciate the renminbi?
Well, yeah. I mean, Rudy would have some choice phrases that would be more colorful than anything I can come up with. But yeah, I mean, this is look, if one of the things we've done is we've displaced China as being the prime bad actor in the world economy. China has been a bad actor. They have kept an undervalued currency. They have failed. China has a problem, which is they don't consume enough. They have excess saving. They're running out of investment opportunities at home. They've tried to close that gap, to square that circle by running big trade surpluses, which they can do because the capital controlled an undervalued currency, but the blowback from that has been growing. Even, if Trump weren't there, if we had a sane person as president of the United States, that sane person would be taking a very hard line on China because the Chinese are in fact not good They're not team players in the world economy. And the Chinese are still trying to do that, which is insane because it's the United States clearly, is not going to be a market, and the Europeans, the rest of the world is not going to take their stuff either. So they are not helping.
Right. Paul, one final question, and it's a fun question because the Republicans love to go after you. There's a primal scream, including the senator from Massachusetts, Elizabeth Warren, and others. Republicans, do something. You're at a breakfast coffee with Thune of the Dakotas this morning in the Senate. What do you tell John Thune to do?
Yeah, I mean, look, all of this is happening because Congress ceded control over trade policy to the president. They did it a long time ago. They did it more than 50 years ago. And because presidents were assumed to be more interested in the international position of the United States than individual Congress people would be. Congress can take that back. And there's actually a lot of bipartisan support for that. I think people in Congress, they're not idiots. Not all of them are idiots anyway. They do realize that this is crazy. And all they need to do really is make trade policy like the rest of policy, something that Congress has to vote on. There are reasons why we didn't do that, but now Trump might veto a change in legislation, but he's that would put him on the spot, and if necessary, overrule him. Just make this take away his authority to do this crazy stuff.
Okay, Paul, we got to leave it at that. Thank you for starting a morning with us. Paul Sweeney and the whole team thank Paul Krugman for his effort. Look to his Substack, which is really lighting up. I can't say enough about it. It's really it's more heated than it was with the New York Times for those of you that love and disagree with Professor Krugman.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
John Stoltzfus with us now. He's with OpCo, with Oppenheimer. And we're thrilled he could be with us. He's been a bull that's nailed this over the last 4, 5, 6, 8 years. John, I believe you lowered your S&P call, which was way out there somewhere, as Linda Ronstadt said. But if it was out there, John Stoltzfus, are you still a bull as you cut back your view?
Yes, great to be on the show with you, Tom. I have got to say we remain bullish. We just had to trim the target because the depth of the selling was such that we would have had to have about a 30% upside from the bottom. And instead, at 59.50, down from 7,100 as a year-end target for the S&P 500, and having reduced our earnings projection from 275 to 265, we feel comfortable here, right-sizing expectations based on the damage that has been done related to sentiment in certain pockets. We don't think it's just about fear and greed. We think it's fear and greed is always in the markets, but on top of that, there's need to invest for serious purposes like retirement, kids' education, in retirement, all kinds of things like that, as well as you have, based on innovation in technology, we believe we're in a watershed period on the timeline of financial history here. And manufacturing history with what AI is eventually going to do. So we feel comfortable, like John McLaughlin, I think it was his second album, Our Goal is Beyond where we are right now, but we're quite aware of what's happening.
He's so sophisticated. Yep. I can't keep up.
No.
John McLaughlin had a scalloped neck, like between the frets of the neck, he had the wood scalloped out.
Really?
Get it better in a different tone.
There you go. Hey, John, it's just, I'd love just to get your perspective. You've been in the markets for decades. What did you make of the selling over the last several days here?
What did I make of the selling?
Yeah.
It looked like the negative pitch book. Generally speaking, when something happens that creates a catalyst for bears, skeptics, and nervous investors to sell without FOMO, in what is likely a secular bull market. You get that kind of thing. You bring out the negative pitch book. It gets negativity to infinity is projected. The market gripped with fear in the trading community. A lot of people are looking, I would think, based on the selling, probably looking for their next vanity plate on their next trophy automobile related to selling in this kind of a period. But for investors, just as your prior guest said, there's the opportunity to look for, we've been saying it for a long time, babies that get tossed out with the bathwater. We don't think it's a buy the dip moment. We think right now it's shopping list. We like what's been beaten up the worst of the quality sectors, infotech, communication services, consumer discretionary. Yeah, they'll keep shopping. And then financials and industrials, which we think are pivoted well for where we're headed once we get through this very uncomfortable period where the tariffs were just simply priced too high for the market to digest without some pretty serious indigestion. It wasn't, we don't think it was a tantrum. We think it was a genuine protest that this was a bit much. It's tariffs 101 in the administration's previous run were one thing. Tariffs 102 during the Biden administration, one thing. But this was tariffs 401 or maybe graduate studies based on the fact that it's really been over 100 years that we've lived with this kind of proposition in tariffs. There aren't anybody, I don't think anybody is around who's alive or knows that they're alive who remembers this.
Is Mag 7
this kind of a period? So.
Is tech an opportunity here? I mean, they were trading, 38, 39. I got Apple with a P 25-ish, 26-ish. Is tech an opportunity, John Stoltzfus?
We have to think so, Tom. We're all on the upgrade cycle. Without naming the company, I was in a big store where they sell technology yesterday.
John, I know you don't do individual stocks, but a lot of people are in these things. Not to be trite about it, there's some real losses taken out there. As we said to Cam Dawson, are we still in a bull market?
I believe so, and I believe it's related to that watershed period on the timeline of manufacturing history and technology's history that revolutionizes things going forward, and that will bring its own questions and agony at different points when we take a look and we see the disruptions within industries, whether it's in hiring or businesses that don't adapt well to the new world. That's a whole other story up ahead. But overall, the market's going to be looking for what builds earnings growth. Where does revenue growth come from? That's what the market really cares about, and that's what appeared to be very much in danger near term on April 2nd when the tariffs were brought into the showroom, so to speak.
Hey, John, what have you done with your S&P 500 estimates?
Yeah, with the S&P, we went from 275 earnings projection to 265. So, it's definitely a haircut on that. And then we went from 7,100 as a price target year end to 5,950. Still looking for we're looking for about 17% upside from where we were on Friday, which is sort of parallel, if you think about it, to where we put our target on December 9th for this year. Last year, we put it in for this year, and we were looking for about 17% upside from that level, which was pre the peak of February, February 19th. We were looking at 71, thinking that was rather conservative based on a year where we'd seen, a pair of years at around 23%. Respectively for 23 and 24.
From where we are right now, that John Stoltzfus call is up 13.8%. John Stoltzfus of Oppenheimer Company, thank you.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
She's never upset anyone in economics. Ellen Wald of the Atlantic Council joins us right now. Ellen, what is Saudi Arabia, or frankly Exxon of Texas, What do they do with $59 oil?
What do they do with $59 oil? They sell as much as they possibly can, because the more they can sell, the more money they can make. It'd be great if it was higher, but at this point, I think they're stuck with just trying to sell as much as they can. And some countries like China will probably see it as a time to stock up.
Is there a break-even price for Ellen Wald? Paul, where's yours, Paul? 55?
55, I think.
Paul's working with $55 a barrel's break-even. Where's Ellen Wald's break-even?
It really depends. I mean, there are producers in the U.S. whose break-even is much lower. Remember, Saudi Arabia's break-even is about $6. So no matter how low your break-even is, Saudi Arabia and Aramco is going to come out better. Yeah, it's about $6.
Wow. See, I watch Landman, Ellen, so I feel like I'm an expert on all things oil and gas. But where's the U.S. here? I mean, the U.S. is now the largest oil producer with 13 million barrels per day. What do you hear from the U.S. producers here?
Yeah, what we're hearing from the U.S. producers is a lot of uncertainty. All of this trade stuff is really throwing them for a loop. They are very, very concerned, especially smaller producers. Remember, there are a lot of small producers still in the United States, and that accounts for a lot of the oil produced. Yes, we have a lot of large producers, but we're still really a country of a lot of small oil producers, and these kind of fluctuations can really impact them. And the tariffs are causing huge headaches when it comes to the steel and the kinds of products they need to drill oil. And while we're not seeing that impact production right now, that is going to come soon. We're going to see companies making decisions to not complete a well simply because it's too expensive. The goods they need, the tubular goods, are just too expensive to make sense, and they will leave that well kind of unfinished, waiting for the price to come down for when it makes sense. So I wouldn't be surprised if this continues, if we do see production starting to trend lower. And I think that will also be reflected in some of the new EIA forecasts that we're going to see coming up.
So, Ellen, at $60 a barrel here, I mean, it seems to me that, that reflects concerns about global demand going forward, given some of these tariff-induced uncertainties in the marketplace. Does OPEC cut output? Do U.S. producers cut output?
Well, U.S. producers are going to cut output if it makes sense for them economically and financially. OPEC, on the other hand, can make that decision, for, I would say they mostly make it for economic reasons, but they can decide as a group, either to halt their planned production increases. They've already gone through with the one that started in April, which was a very, very minor increase. So it's a very small amount of additional oil in the market. But the idea is that they're rolling, they're pushing forward with this. They can decide to pause that, and they may very well do that, next quarter. Decide we're not going to increase anymore until we see how this plays out.
Ellen Wald, a senior fellow at Atlantic Council, she continues with us. Her book, Saudi Ink, is definitive. Ellen, I need an update on this because Paul and I they turned us down for the trip to Vienna for OPEC. Is it OPEC or is it OPEC Plus that's working into 2026?
I see a continued OPEC Plus. We've seen a lot of troubles in this group, a lot of troubles in paradise. There was a time where Russia and Saudi Arabia almost split, where Iran, problems with Iran threatened to force the whole group apart. But I think we're going to see it continued. I do think right now the country to look at is actually Kazakhstan, and their willingness continue to go along with any kinds of cuts or stays in production increases. They really want to increase their production. And so I think they're really maybe the troublemaker to keep an eye on.
Ellen, how about Russia? I mean, if we are moving towards some maybe level of peace in Ukraine, does Russia's supply of oil and natural gas, does that find its way back into the mainstream?
So the interesting thing is that there's still plenty of Russian oil and Russian gas on the market right now. The question is if there is some kind of resolution and the price cap policy and sanctions end, then that Russian oil, which is being sold at a discount because it is contraband or sanctioned or under this price cap policy, the Russians are going to say, we're not going to sell it for your discount at from the normal prices. We're putting it back on the market at regular prices. And so I think that will actually push prices up because they're not going to take, they're not going to accept these lower prices for their oil. They're going to say, we're in the clear now, so, pay up.
So, Ellen, give us a sense here. I mean, what's the industry, how's the industry thinking about demand here? I'm guessing the oil industry, the energy industry in general is like everybody else. We're just kind of floundering here, looking for some direction. Is the feeling that demand is going to be soft going forward globally?
I do think that they feel like in the long run, in the bigger picture, the demand picture looks good. But in the short term, there are some serious concerns given this kind of shock to the whole global economic system, and that it could push us into some kind of economic state where demand is lower. There's some interesting news about whether the U.S. is going to, impose serious fees at port of call for ships made in China. I mean, that could impact the oil industry in a pretty serious way. And so I think it's really just this wait and see, don't make any decisions. We could be in for some real pain in the short term.
Ellen Wald, thank you so much. We need a new book. She's with the Atlantic Council. Saudi Inc. is her jewel on Riyadh and the royal family of Saudi Arabia.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
I'm going to cut to the chase. If Tom Hanks had to make a war movie, he'd make it out of John Thune's father. Thune in South Dakota grew up in a family. His father won the Distinguished Flying Cross, like the real deal in the Pacific. John Thune came, the typical political life, star athlete. Where in God's name, Libby Cantrell, are the GOP and the good senator of South Dakota?
As it relates to trade?
Trade?
Yes. Well,
where are they?
Well, I think first of all, I think privately there is a lot of pushback
this
to
is
the
not
White House.
time to be private.
However, Tom, I think it just underscores the fact that Congress does not have a lot of levers here.
Why?
Because they intentionally bequeathed delegated tariff authority to the president through various trade acts. 1962, the Trade Act of 1974, IEPA of 1977.
So you're saying they can't go back to what they had?
Well, they can, but they would need a super majority. They would need 2/3 of each chamber in order to override what would inevitably be a veto. So I think there is a practical element here, a practical constraint in terms of Congress.
One more question. Sweeney's looking at me like, Tom, can I get a word in here? Let me cut to the chase. Did Trump lose the GOP House in the Rose Garden?
Look, no. I don't think so.
Wow.
I mean, I think this speaks to the fact that this party is the party of Trump. And many folks in the House have the president to thank for even being there in the first place. And so this is why I think there's been a real reluctance to push back in public. Again, there is some private pushback. But again, I think this is a worldview that President Trump has had for 40 years. This is what we keep telling our clients. And he ran on this. He believes he has a mandate to fulfill this. He believes that there's a lot of unfinished business from the first administration. And I think that the market obviously wants to maybe see through this or hope that there is something, this will result in a different outcome. But our view is tariff rates are going to be going up, and that will have a headwind on growth and likely have implications for inflation. To the degree is going to depend on the stickiness of all of this, obviously. But I think that it is naive to think that we are not going to see probably significantly higher tariff levels.
And President Trump has been very clear that he views the U.S. trade deficit as the effective scorecard between the U.S. and the rest of the world. And that scorecard shows a deficit of $1 trillion. Is that the right way to look at it? Is that a fair analysis?
This is what what I tell our traders as well. It is really not our kind of role to editorialize or to judge whether this is good economic policy or bad economic policy. what we think is, in terms of providing alpha for our clients, is what is likely to happen, not what should happen. So we may quibble about whether the trade deficit is the right scorecard, is the right metric, but the president is very focused on, and it's not even the trade deficit writ large, it is the goods trade deficit. So it is very specific, and he has this very specific metric for success. And again, people may disagree with that, that's fine, but like that is not going to change, I think, what is likely going to be the outcome, which is he is going to be focused on that as a metric of sort of future success.
And one could argue that to balance potentially those economic headwinds that would result from higher tariffs, he and his administration need that tax policy to go through like quickly. Is that something? How do you guys handicap the? Yeah,
so I do think that is going to be a big pivot and a big sort of shift in focus, if you will. It already has been. Obviously, the House and the Senate are kind of working through the machinations of the very kind of tedious legislative process. I would not underestimate Trump's bully pulpit here, though, in terms of getting this through. I think what you're looking at is, there's these different budget resolutions that sort of set up for the broader tax bill. They're quite different. But I think at the end of the day, Trump will get what he wants in terms of the tax bill. And that is where the GOP is.
Maya McGinnis was with us yesterday or the day before. I'm sorry, it's a blur, folks. And the basic idea is Libby Cantrell says they're just going to overlay more debt on the deficit. Deficit on the debt. I can't remember which it is.
Overlay the deficit on the debt. Yes. I mean, look, but I think a couple of things, Tom, is that tariffs do generate revenue. And so if they are the sort of maximalist approach on tariffs, there could be actually pretty significant revenue coming into the Treasury coffers. Now, I don't think that's going to go to pay down debt. I think that is literally going to go to pay for more tax cuts. But that can, in terms of growth, like balance out some of these sort of cross currents, that we've been talking about with our clients.
So President Trump and his the folks that speak for him are talking about the number of countries that are lining up to negotiate deals with the U.S. Is that something that you guys think will be successful? I mean, are we going to get a lowering of some of the expectations for tariffs, or should we just kind of layer in a base level and go from there?
Well, so I think, my view is that sort of the destination here, at a minimum, is that we see a universal 10% tariff, that we see sectoral tariffs on chips and pharma and autos and what have you. And then we see these elevated tariffs on China.
So when you say that to your managers, quickly here, when you say that to your managers, how do they respond?
They say
bond inequity.
Yeah, headwind to growth and maybe a little bit of upward pressure on inflation. But we think this is more of a growth story than it is.
Okay. Are you making an inflation call here? I got to make some news here.
No.
Joining us, the economist.
I am actually not trying to make news.
So is PIMCO talking about an inflation vector, or can they actually turn it around down the road to a lower growth disinflationary vector?
And I think a question. Well, I think this is, and again, not to commit here, but I do think this is going.
We want that.
This could be an increase in the price level, a one-time increase. I think obviously it depends on what happens to inflation expectations. Inflation obviously has been high, so this could feed into increased inflation expectations. But we really do think the story here is on the growth side than the inflation side.
I must. I mean, I'm seeing a few people model out negative nominal GDP, which is like back to England, 1930s.
Yeah, I don't think we're that far. Again, you do have these cross currents in terms of policy. If you're just looking at tariffs alone, it looks very bad. Right. But if you're actually, layering in some of the tax cuts, tax policy certainty, and all of that, it may be a little bit more of a complicated picture.
Libby Cantrell, thanks so much. I don't agree with anything you said. Libby Cantrell,
thanks, Tom.
Thank you so much with PIMCO. We'll see what the Republicans do in the House.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
James Steele, Chief Commodities Analyst at HSBC Securities USA, joins us here in our Bloomberg Interactive Brokers studio. James, I see gold here up another $57 today, $3,031 an ounce here. Is it too fast for gold here, or is this a rational gold market, do you think?
Well, I think you've got to look at what happened in the last few days. And we had a big decline in gold in league with stock market declines. And I think it's easy to ascribe that to gold not being a safe haven or lacking safe haven as an asset. But actually, the opposite is the case. because what happened, and this happens with periodic stock declines, is that you get gold liquidation by those who are already long, and gold therefore fulfills its role as a quality asset. Now, when the smoke clears a bit, typically after a stock market decline, it depends on how long the decline goes on for, but usually after a few days, the smoke begins to clear and gold stabilizes, and you get the safe haven demand coming back.
So, for mere mortals like us, closest I come to gold is, gold and olive oil. The answer is Beijing's on the phone to where and says, sell 47 bars of gold. Is that what happened the last couple of days?
No, it wasn't so much from, I think, Asia as it was those that had, some of it certainly was, but it wasn't centrally planned. These are asset managers, portfolio managers, and others, ETF holders.
Okay, so it's not central banks.
No, not at all. This was not orchestrated on a central government level. This was people who, for a couple of years now, have been accumulating gold or longer as a portfolio diversifier. And in need, when you need to cash your insurance policy in, you liquidate a little bit. But that seems to be coming to an end today.
How do you get a sense of value of gold, relative value? How do you think about? You wake up saying, "Boy, gold feels expensive here today." I'm like, me as a stock analyst, I see my PE ratio, and I can look at that versus the market or versus history. How do gold?
Yes, it's not. Unfortunately, well, I suppose fortunately, because it keeps me in a job.
Right.
That it's not as straightforward as with equities. It's also not as straightforward as other commodities, where for copper or for metals or for grains, you can look at cost of production. You can look at days inventory. My friend Javier Blas, he will tell you about days in consumption for oil. None of these things apply to gold, and that's because gold is part currency and part commodity. Certainly supply-demand balances are important, but if you were to look at, for example, the cost of production, that would not give you necessarily a clue as to where is going. You have to be sensitive not only to the underlying fundamentals on a supply-demand basis, but also on the geopolitical and the financial market moves. This is what makes gold so interesting and frankly unique.
James Steele with us with HSBC. He's been so helpful to Bloomberg Surveillance with perspective on gold. We welcome all of you on your commute this morning across the nation. Good morning, Mexico. Good morning, Canada. Good evening on the Pacific Rim, and of course, out on YouTube, Building Every Day on Bloomberg Podcast. Really thank you for the kind comments out on YouTube, particularly the heated comments about some of our guests like Stephen Merritt and Paul Krugman as well. Never any negative comments about James Steele. I've never seen him. Okay, on the Bloomberg, I went log Nixon. I took gold back to $35 an ounce. Big leg up in the 80s. I remembered I could only shave like once a week. And then there was a malaise from the 80s to 2000, and then basically another moonshot. This pullback in gold, is it a blip on the map? Or is that fear out there that this is the beginning of the taming of gold?
I wouldn't quite so far as to say it's a blip. We have a range this year. Our forecast range is $2,800 to $3,350. And we think that's a reasonable level. That's a reasonable range to look at, because if one was to go closer to the $2,800 level, I suspect that we would get official sector buying, that central bank buying, and possibly sovereign wealth fund buying as well, coming back in a bigger way.
Like this the Norse Sovereign Wealth Fund, do they own a lot of gold?
I'm not privy to their gold holdings, but what we have noted ever since 2000. He lies
on here. He knows
where every bar is.
Well, what we are aware that since 2022, the fourth quarter, we've seen an extraordinary jump in official sector demand for gold. And that year alone, if you look at it and compare it to mine production, 1 out of every 3 ounces of gold that came out of a mine went into a central bank vault.
Radio, you're not getting justice here. YouTube can tell. James Steele looks like he's out of a Bond movie.
Exactly.
I mean, he does. He's the guy that knows where the gold is.
Gold is.
Not Goldfinger, like it's like, Daniel Craig and all that. Exactly. Paul, get another rating.
So, all right. So gold up 15% year to date. Silver up 5%. Is that surprising you? Does silver seem cheap relative to gold?
It does not surprise me. And the reason for this is that 6% of gold demand is industrial and 58% of silver demand is industrial.
Okay.
So although it is a precious metal, it is inextricably linked to the industrial cycle and tariffs and the decline in forecast decline in trade, weakness, which we've seen before the tariffs were put on, in industrial production is reducing some industrial demand for silver, with the big exception of photovoltaic. So it doesn't surprise solar power.
Oh, okay.
And so it doesn't surprise.
It's a new look from Tiffany.
Yes.
It doesn't surprise me that silver's down. Yeah. The gold-silver ratio has widened out, which I think will lead to some buying for silver. But fundamentally, it's fundamentally weaker compared to gold.
We're up to 42 listeners this morning. Mrs. Keene listening.
Oh, there you go.
Well, with James Steele of HSBC.
Yep. Gold.
She knows, she has her Bloomberg terminal at home. Yes, folks, she knows how to log on and find out where I am. Okay, so gold is down 6.2% from the peak. Does the price of gold at jewelry stores go down, she asks?
It will, depending upon where in the world you are.
In Dubai, it goes down.
Yes,
I don't know.
In non-OECD countries, you will tend to find much greater price elasticity because the margin is much lower. And so therefore, people in souks and bazaars and jeweler shops cannot afford to adjust their prices. You have a higher markup in the West, which effectively allows you to absorb more one way or the other.
I love busting his chops. It's like so much fun. I know it's not your remit, but I'm going to go there. What does a trade war mean for Broken Hill Properties? What does it mean for Falconbridge, living the Yukon life? What does it mean for the romance of miners or oil drillers, people doing manly things with manly wrenches? What does it mean?
And it is a hard business too, and they operate in quite unbelievable circumstances. That's one of the things about increasing production in gold is being done in increasingly inhospitable places, because we've already looked. The low-hanging fruit has already been picked. But so far, tariffs have not impacted bullion.
Will there be a tariff on gold? I mean,
I suspect not, but I'm not privy to what could happen. So far, no.
Okay.
So far, no.
I'm sorry.
And we know that because of the way the exchange for physicals have been trading.
On behalf of all of Bloomberg, we're sorry that you had to wait for Javier Blas to get off the air.
He is, I've known him for years. He's a scholar when it comes to petroleum.
James Steele, thank you so much with HSBC.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.